Hello and welcome back to Instant Insights. At Global Data Strategic Intelligence, we track over 100 tech, industry, ESG, and macro themes impacting all major sectors. I'm Carolina Pinto, and today I'd like to welcome back Christopher Granville, Managing Director of Global Political Research at TS Lombard. Chris, how are you?
Very well, Carolina. Thanks for having me back.
No problem. And we also have with us Steve Blitz, Chief U.S. Economist, also from TS Lombard. Steve, how are you?
Good. How are you? Thanks for having me.
No problem. I'm very good. So a couple weeks ago, we did a pre-US elections episode. And today, knowing the results, I think we should dive a little bit deeper into how the results will impact the US economy. As we all know, Donald Trump has won the US elections pretty decisively, winning all 7 swing states. And the Republican Party has also flipped the Senate and kept the House. This means that in January 2025, we will get a united government. Now, for this episode today, I kind of just want to delve a little bit into what a Trump win means for the US and the rest of the world's economy. But I kind of wanted to first delve into the theory, what is Trump's approach? And then later on, kind of delve more into what the reality of this approach is, what the implication is. So I think my first question to Steve is, so what does a Trump win and a united government mean for the US economy? And when can we expect these changes to come in?
Okay, so I think first off, I want to say that it's a united government only in the sense that one party controls all three branches of government. But united is a bit of a strong word. And that's because there's a very slim majority in the House, and not everybody's on board with everything. And the fact that Thune, as opposed to Scott, was picked in a secret ballot as the head of the Republican Party in the Senate tells you that while Trump obviously has more degrees of freedom to do what he wants to get done than he would if either house was controlled by the Democrats, he doesn't have a blank check. And I think that's important to understand. And you're already beginning to see that in some of his pushback on some of his cabinet appointments and stuff like that. So I think united government is a little bit of a strong word. Now, in terms of what he wants to do and what he was elected to do, the U.S., like a lot of Western developed countries, but has had a problem with globalization in that it has just hollowed out that mid-income, mid-skill job.
Mm-hmm.
And if you look at the index of industrial production in the United States, for example, it peaked in 2000, and we haven't been back there since. And it's been basically flat since then. And these all sound like economist constructs, but they're real. So the idea is that, and then also with the slowing population growth, which also means you have an aging population, you have a growing gap in your forward gap in your budget, right? To pay for everybody as well as the things you want to pay for. So how do you fix this? If you're just looking at a chart, you say, well, we need to get real growth up. And with a goods deficit, 4 or 5% of GDP, you say, this is what we have to do. We need to move production from outside the world into the U.S., right? Problem for the U.S. is, or really the challenge, is that our trade deficit is made because U.S. firms produce overseas because it's cheaper, and then they get a good markup and they sell it into the United States, right? And so the point of the tariffs, the point of the tax changes, point of everything, and the deregulation as well, is to make it more attractive for industry, U.S. industry, to produce here versus importing. And it's also to make it attractive for foreign firms to produce in the U.S. I mean, Trump made it very clear in the campaign that he'd welcome Chinese firms producing whatever in the United States. So it's not an issue of this has to be American firms producing products for American consumers. This is about just shifting production back, right? So the theory is that if I change, broadly speaking, the terms of trade, right? So I lower the tax rate specifically for domestic production. I put these massive tariffs on. I lower taxes even further because extending these tax cuts, which are coming off, doesn't lower taxes. It just keeps everything the way it's been. So he wants to lower taxes even more and offer other tax incentives. So the thing that Trump also sees the tariffs is a way to pay for all of that because the guess is it's going to bring over $300 billion in revenue to the United States government. And tariffs, by the way, if you go back in history, and Christopher can tell you that, tariffs were how governments funded themselves. So that's the theory.
No, but so the US isn't isolated at the end of the day, and in attempting to rebuild US production and manufacturing, um, Chris, what are the impacts on the rest of the world and the global economy?
Well, let's start with the theory, shall we? And then we'll get promptly onto the real life impacts as far as we can judge at this stage amidst all the uncertainties, which are uncertainties which are inherent in new policy directions. Even before you start talking about the personality of Mr. Trump himself and his unpredictability and his temperamental and nature. So there's really 2 points I'd make on the impact of the rest of the world. The rest of the world is very largely dependent on the demand which the relatively dynamic US economy offers to the rest of the world, importing from them a whole pack of goods and a fair amount of services as well, obviously mainly goods. And this has been the model for growth for not only dynamic emerging markets in East Asia in the post-war decades, which have suppressed domestic consumption and grown through exporting, but also of large economies as well. And crucially, China, as well as exporting and through having that export-oriented growth model, as it has grown for the best part of 2 decades until very recently, itself offered the rest of the world, in particular the emerging world, but also Europe, a very fast-growing and attractive market. Now, China has now kind of hit a buffer which the United States and its associated economies in Europe in particular kind of hit with the global financial crisis of a kind of debt, over indebtedness, and instead of continued expansion of demand, retrenchment. So that just leaves the US on its own as the one big magnet for the world's production. And if the Trump administration is going to try to flip that the other way and to reduce US consumption and try to make US more of a producer and an exporter, then the rest of the world has to increase its domestic consumption to balance that. And that's something it should be doing, especially richer countries, above all European ones. I mean, Germany notoriously has been anti-socially tapping foreign demand for many decades, much less so now because Germany's had a negative terms of trade shock, as economists say. That basically means its energy imports have got much more expensive. But its economy is structured in that way, even today. And that the same goes for Japan and many other economies, both developed and developing. So that's the theory. That's what they should be doing. Will they do that? My last point on this segment would be to say the classic experience is that if a major trading partner slaps on protectionist tariffs, trying to make it more difficult for you as an external trading partner to sell your stuff into them, you will retaliate. With Trump, of course, you may bargain. The Europeans have got a strategy. They're going to try to bargain with Trump, try to say they'll import some more liquefied natural gas, LNG, from America to try to soften Trump's tariff blows against them. But if that fails, they will simply retaliate because Europe, for all its economic problems, remains a rich and attractive market. And they'll try to make it more difficult for the US to export there. So then you get the risk always in these situations of a kind of vicious spiral of escalating tit for tat in protectionism.
So we've established there's most likely to be tax cuts, global tariffs, and then also a dilution of fiscal regulation within the US. Steve and also Chris, if you have any input, what is the actual implications? What is more likely to happen in this situation with this approach?
Yeah, so let's think about this where everyone's harking back to the Smoot-Hawley, which was the big tariffs that really helped kick off and make worse the Depression in the 1930s. And there was a concerted effort in the world to remove tariffs after the Second World War, and it had its intended impact of raising incomes everywhere in the world. And so there's this visceral anti-tariff reaction, and I am with that, right? But we also know that there are countries in the world that have gamed that system, right? And to their advantage, which is tariffs are a way to push back against that. But what I really want to focus on in terms of going from practice, from theory to practice, does this work? My guess is not as easy as they want to make it sound, right? But when you disrupt something that's been in place for 40 years, right, which is this quid pro quo of money comes here, we buy everyone's overproduction, the world gets wealthy, American consumers feel good because they spend less money on things, and then because we've had outright deflation on durable goods, 40 years, 30 years, I should say.
Stuff gets ever cheaper.
Yes. And so when you break that,
Yeah.
when you break that arrangement, and you disrupt it, exactly. So, we can sit here and spin the good story, we can spin the bad story. But I think the right story is to say, when you break something, you get intended, but also the rule of unintended consequences. And if we knew all the unintended consequences, I like to say Christopher and I would be retired, living on, not necessarily together, but we'd be retired living on an island someplace.
Yeah, swapping boring stories in a country club or something.
Yeah, exactly. So I think that the world is, so there is a whole host of unintended consequences.
But what are some of these? Can you name us some of the unintended consequences that we do know?
All the uncertainty will surely inhibit investment, no?
Yeah, I think what Chris says is exactly right. Uncertainty inhibits investment. You get people are, my favorite is that the Fed, you don't have control over the budget, and the budget deficit keeps growing, and then the Fed has to balance the budget deficit using its balance sheet. It has to balance the budget deficit and keeping that cost relatively low by borrowing and keeping in money from the rest of the world. Yet at the same time, keeping an eye on inflation and its inflation and employment mandates. And inflation is more likely to be higher going forward than lower, right? Simply because the economy is going to continue to expand, and you're already at pretty much your full employment, and you're going to start. If you're right, if he's right, and you start bringing in higher paying jobs, that means incomes are going to rise, not because of inflation, but because people are going to stop working at McDonald's. They're going to get a job in a factory, so they're going to make twice as much. So all of this, right, puts the Fed in a bind. Right. And these unintended consequences really, can the Fed continue to hold this together with its balance sheet? And that's the stresses. So that's my favorite stress point. But it really gets down to capital flows, interest rates, and a budget deficit in the United States that's growing faster than the economy itself.
Okay, so we will have definite inflationary effects.
Yeah, and we're not talking about going back to 10, 12, or 15% inflation, but we've come out of a world basically where inflation has been 1.5%, 2%, where most people only understand inflation going back to 1.5%, 2%, where, Christopher and I are old enough to remember where every year prices don't go down.
Double digit, yes.
Yeah, and you, Carolina, you and your generation, and actually a few generations older than you, are only used to things getting less expensive. And so if you just get to a 3-4% inflation, that's a very different world, right, than the one that we've had. And the promise, obviously, is that you're going to get back to low inflation. You're not. You can't look at anything that Trump wants to do, add it up, and say that's going to bring prices down.
That's certainly true. And then if Trump does go through, a big part of his economic policy is the tariffs. He has threatened tariffs 10 to 20% on global tariffs, and then on China up to 60%. Chris, what are the impacts of these tariffs on the global scale?
Well, if I can spend a couple of minutes just setting the rest of the world to rights after Steve has dealt with the US, and then we'll probably
Go right ahead.
leave our listeners in peace. I would say it's variations on the same themes, and my summary of the themes is pretty straightforward. If you attempt a structural break in policy, Steve described a comfortable pattern which had been well established for decades, then there's two implications. First, you get pain before gain. Pain comes up front, and the gain is further down the road. And then secondly, the very disruption involved in that structural change makes the gain, the pot of gold at the end of the rainbow, more difficult to come by. So those two things will apply in the rest of the world. I mean, let's take China and Europe. China will obviously retaliate against the US for protectionist measures, but it will try to divert its own export trade and its own outward investment to the rest of the world, both for rerouting their exports to US. We saw that in the first Trump trade war in 2018 to 19, a massive surge in exports from places like Vietnam or Malaysia to the United States. And if you look closely, a lot of those exports had a very large part of Chinese content in them. But also simply just generally expanding China's trade footprint into the rest of the world and also its investment footprint. That's what we're going to see. And that's going to be caught up in the broader geopolitical and geoeconomic rivalry between the two great powers in the world, the United States and China. So I think that's my first thing. The second one would be Europe. Now, Europe is squeezed in a very nasty place. It's export dependent. The China market, which has been good for Europe for well over a decade, is now stalling, if not stagnating. The US under Trump is going to become less accessible. What are they going to do? Well, here's perhaps the silver lining. As I said earlier in our podcast, they're going to have to stimulate domestic demand. Trump believes, and Steve touched on this already, the Europeans are rich countries. They've been coddled by the United States for decades when it comes to their security, which the US has paid for. They should stand on their own 2 feet and look after themselves, especially their security. And if they perceive a security threat from the East, a certain large country, beginning with an R, they should deal with that themselves and pay for it.
So,
And
Christopher, I want to bring something up here on this question. That I agree with everything you're saying. So my question for you is, someone's going to have to be the lead dog on this, right? Otherwise, it's just all individual countries,
Yep.
which seems the way in which the politics, domestic politics inside Europe is going. So who becomes Europe's spokesman?
There is an image which you often hear in Europe, perhaps has to do with the Catholic Church and the Vatican, the Grey Cardinal. It's not Kissinger's opposite number in a ministry or a head of state's office. You pick up the phone to them, but it's a person who has the authority, and the formal elected officials take their cue from that person's authority. And that person is Mario Draghi, who saved Europe when they had their great crisis of the monetary union in 2011 through 2013. And now he has set out very hard truths about what Europe must do, which is essentially to mobilize finance from its so-called federal balance sheet to invest and raise productivity, invest in things like the energy transition, in the defense industries, those two things in particular. I have no idea whether this will work or whether this will happen, but this is my only answer to Steve's question is that would be the mechanism if it works, and we'll see quite quickly. The next 6 to 12 months will be, I think, extremely important and revealing in Europe, one way or the other. With France and Germany, the two leading states, and the conventional answer to the Kissinger question is a kind of hybrid of those two countries, first and foremost. They're both in political crisis. If they can if they can emerge and agree, as they did during COVID, to mobilize finance for investment in Europe, then we will see that the potential silver lining for Europe has materialized. Otherwise, no, not. So it's on the cusp. It's a fascinating situation with very high stakes for the old continent. But sometimes you need a kick up the proverbial backside in order to act. And certainly that's been the track record of European politics. And we'll see if the kick, with increased impetus from the US election result, will be sufficient to push them over that line. Watch this space. I'm sure we'll perhaps be getting back to it in future podcasts.
My last, very, very last question, because we hadn't touched on it, is when is these economic both the tax cuts and the tariffs, when are they happening?
Well, the tariffs can start right away, right? Because it can come under executive order. Now, it gets a little complicated to keep them on in time and whatever, and you need congressional approval. But here's where your phrasing united government works, right? Because the Senate will just let him continue to do it, and they're not going to push back on that. So that can be done right away. The tax changes will occur over time, right? And
they won't hit till 2026, really, will they? They won't be first.
No, that's correct, Christopher. Yeah, they really don't, because first of all, he's not just going to be able to cut taxes and get everybody to vote for it. And with that very small margin in the House, and given the traditional way in which midterms go, odds are the House of Representatives will be Democratic in 2 years. So he's not going to have that blank check to do that. But in terms of the timeline, just as Christopher said, it's a 2026 story. There's some stuff they may try and push through immediately in this tax year, but it's really going to be a 2026 story. So it's tariffs this year, taxes next year.
Okay, that makes sense. Well, thank you both so much for those insights. Thank you for taking the time to come on the podcast. And yeah, everyone at home, thank you for listening. From us at Strategic Intelligence. See you next time.